very good morning to everyone who's joining us today. So this will be the first edition of the Vakil Search Fundraising Masterclass. And we are fortunate enough to have with us today Mr. Kumar Shiralagi, MD of Kalaari Capital. So Mr. Kumar has been an active part of the Indian VC ecosystem for about 15 years now.
Yeah.
A very prominent venture capitalist, so we're very lucky to have gotten him for our first talk. So the format we're following today is going to be a talk from Mr. Kumar on how you approach fundraising, especially for early stage first time entrepreneurs, followed by a brief Q&A session for which we're open to taking questions from the audience. So over to you, Mr. Kumar.
Thank you. So good morning, everyone. So today we will discuss how to think about fundraising for startups or small businesses, or how should entrepreneurs think about it. So that really is what we will discuss. Now, the question will come up, why do you need to raise money? What will you use that money for? And at what point should you raise the money? When is the right time to raise money? Who should you go to raise that money? And how do we go about presenting or talking to the folks to raise the capital? So these are all some of the topics we'll try to cover in the discussion today. Again, since the topic is so broad, it is difficult to cover this in any kind of depth in a half-hour discussion. So it will be extremely superficial, but I'll try to give you all the points that one needs to think about, and particulars for your businesses or a business of your nature. What you need to keep in mind could be deeper, and maybe in the end, if there is some time, people can ask questions that are relevant to your businesses, and we can try to address that. Otherwise, I'm going to keep it pretty broad. And even the scope of fundraising, I'm going to limit it to companies that are trying to go raise money from institutional folks, meaning larger capital, trying to grow the business into a larger business, and so on. Although I'll start off with the need for funding at a generic level, it'll be more focused on institutional fundraising. Now, so here we are going to talk about entrepreneurship primarily, and entrepreneurship has different flavors. One is, anybody who starts his own business with typically profit in mind is an entrepreneur. There could be other reasons, of course, but typically they are starting the business with the intent to make a profit. And it can happen at a very small scale, and it can continue to grow. And at various stages, whoever has started the business will need capital. And so the question is, at what point, who do you go to, or how do you raise the capital? So everyone needs funds, and everybody can get funds, but it's going to cost them a certain amount of money to even borrow that money. So that is called the cost of capital. And the cost of capital could be different for different kinds of businesses, depending on what kind of risk there is for that capital. I'll start with an extremely simple example. Let us say there is a fruit seller who wants to sell fruit at the corner of a street. Now, he needs some money to go buy the fruit, keep it in the cart or wherever he keeps it, and then he sells them. And then once he sells, he has made some profit, and he has to return the money to whoever he has borrowed it from, along with some amount of interest. And typically the way it is done is, let us say I'm a fruit seller, I may borrow 500 rupees from somebody I know. It could be from a relative or somebody who's willing to say, I'll lend you 500 rupees. Or there are a lot of money lenders out there who are willing to do that. So you take the 500 rupees, go to whatever the market, buy some fruit, come back to the street corner, sell it. So you will mark it up, and obviously, you'll make some money. Let's say you sell it for 800 rupees, 900 rupees, if the fruit is good, and if it's a good day. Of course, he has made a net margin of about 300 rupees because it cost him 500 rupees to bring all those things. He has to pay the transportation, and there are other expenses that are involved. So he makes maybe 300 rupees. Now, he had borrowed 500 rupees early in the morning. Now he goes back to the gentleman who had borrowed the money from and gives him 510 rupees. So, that has worked out good for him. He got his 500 rupees. With that, he has earned a couple of hundred rupees, subtracting all the costs, and he's paying this guy 10 rupees. And next day, he goes, borrows the 500 rupees back, repeats it. So every day he's able to make a couple of hundred rupees, which ekes out a livelihood for him. Now, even though it doesn't seem like a large amount that he's paying 10 rupees at the end of the day, in the end, it amounts to a lot of money, because every day 10 rupees is 300 rupees per month. That means, that's really 60% per month that he's paying in interest, which is really 6 or 7 times the capital by the end of the year if he keeps on doing that. If he does not save enough money to fund himself, he is paying 600, 700% interest per year. That's a huge amount of money to pay. It's almost criminal to say that, that is the amount of money, that is the amount of interest that he's paying on that money. But unfortunately, the cost of that capital that he's borrowing, because of various uncertainties, risks, and so on that are associated with his business, is humongous. Now, it's a pretty simple business. He buys it and then sells it. There aren't too many variables, although, weather could destroy your day, rain, nobody buys the fruit, there is a strike, then, you can't sell it and the food all goes bad and he doesn't even get back his 500 rupees. So there is risk involved. So the person who is lending money, he knows that. And also he cannot give this guy too much money. It's really 500 rupees. He can only repeat that with a bunch of people. So it is not like he can, even the lender can start a big business with that. There are money lenders who want to lend greater amount of money, and that cachet for that will only build over time. So because of the perishability and of the goods, he really cannot keep it for long. So now you look at, for instance, some of the product which is not perishable, meaning you can keep it for a day or two. Let's say books, for instance. So you see people on trains and buses selling books. So he would do the same thing. He will, borrow money from somebody, buy some books, sell it, make a profit, return the money to whoever it is, maybe not the same day, but maybe 2 days later, a week later, at these kind of interest, and then he ekes out his living. Right? These are good for people who want to lend small amounts of money, a few thousand rupees at best. The moment you want to approach people for larger amount of money, you don't have the trust factor for people to trust you with that kind of money. They worry that you may run away with the money, or you may not be able to sell it, so I won't get my money back. So now, and also the business is not really scalable. You're always dependent on what you can sell. It's not like you can hire somebody, go to multiple street corners. So that business, whether it is fruit or books, does not appear scalable, so it cannot accept a lot of capital into the business. Then comes somebody who says, hey, internet is growing wide, so I'm going to sell books on the internet. That's how Amazon started. So, all of a sudden your reach is significantly more, and the book is not going to go bad. Sometimes you may not even keep the book in house. You float it and just take it from somewhere and deliver it, and you're making money on it. So investors are, wow, this is pretty scalable. So I don't mind, lending some money for this business. And as it grows, and when you're able to sell more and more books, there is capability to raise, greater amount of capital, and consequently the business continues to grow. So even though at a very small level, the book selling was not a venture backable business or could not accept too much capital, all of a sudden Amazon, as we know today, has raised, hundreds of millions of dollars and does business. And today, I think the books is a very small part of the Amazon business. It's in single digits, 5-6%. But that's how it originally started, especially with money from his parents, a few $100,000. And later on, of course, venture capital firms also invested in them, and business has grown. So now the cost of capital at 600% interest is not viable for to borrow at large amounts of capital. So then you need to, as an entrepreneur, you need to figure out, what is the amount of capital that I need to raise at what point. Is my business scalable, and are there logical points at which I can take a break and then go back and raise money, grow it to the next level, and so on? Is my business non-linear in the sense to grow to the next level? Do I need significantly more capital, or a small amount of capital can grow it? And also, is there an opportunity to make it extremely large? Because if the business itself limits to a certain extent and is not scalable, then again, that business may not be attractive to a lot of folks who want to invest in it. So you have to look at your business and say, can it scale? Can it become large? And will I be able to borrow the capital that is required to grow it to that extent? So those are factors that will determine whether its business can become big. Now, the next question is, what is the capital for? And as small business owners or entrepreneurs, you all know that you need capital for everything that you do in the business, even to incorporate the company and to hire your first few people and to start developing the product, to sell it to somebody, etc. So one of the most important attributes of any entrepreneur has to be that he's a fantastic salesman. So he has to sell whatever the concept is or whatever the business is to everybody. If you're good at being a salesman, then there is a good chance that you have a ability to raise this business. Why do I say you have to be a salesman? Salesman doesn't mean that you're selling the product to a customer. It also has to do with selling a business or business concept to folks who want to work for you. Sometimes people work for free or maybe sweat capital, but you have to convince them that there's a good business to be in. You should take some equity possibly and then work for you. And to the first customer, you have to sell it. And to an investor who wants to put money into a company, you have to sell your vision, the business. And that's when he says, okay, this guy has something interesting. So for that reason, I should invest in him. So you have to be a fantastic salesman to be able to do that. And like I said, a lot of businesses in India are services kind of businesses where you don't need too much capital to do the development of the product. So you need to figure out whether yours is a service business or a product business, because a lot of times product businesses go through this J curve where in the initial part you incur a lot of loss because the product has to be developed and you need to hire people, and especially if it's a technology business, highly competent people, coders and so on are required. And initial part you'll be investing and you'll be test marketing it, so you're incurring loss through the initial part of the business and then it begins to grow. Whereas in a services kind of a business where you will need a small amount of capital, you go sell it to a customer, get paid for it and then invest that wisely to continue to grow. And people who may be working for you, maybe even be working for sweat equity and so on in the business. So services business will not be as cash hungry as some of the product businesses which may require a lot of capital upfront. So you need to figure out what kind of business yours is, and that will determine how much money you need. Now, what are the factors that determine who you go to raise this capital? Now, first question is, how much money do you need? So as a business, whether you have just started it or you've evolved it to a certain extent, the amount of money that is required has to be to take the business to the next logical point. You cannot raise money, or nobody can raise money to build a business from 0 to 100. Even Amazon didn't, or any of the companies will raise money at various stages. So the question then is, how can you raise enough capital to get to the next stage where your business looks attractive for the guy who wants to fund it further? Or can you establish enough proof points in your business to say that, hey, this product is good, people want it, and there's a large market for it, and I should fund it further so he can take it either globally or locally or wherever it is, depending on the product. But the scalability factor has to be addressed for people to trust you to, invest more into your business. That means you have to start off small and then invest to a point. And typical cycle in the way we invest is about 18 months. So can you, over the next 18 months to 2 years, can you grow it to a meaningful size so that you can again go raise money and continue to build the business? Now, who you go to depends on what the risk of that capital is. So there comes the equation of risk versus reward. Now, different folks have different risk appetite. And in the earlier example I gave of the fruit seller, obviously the risk is extremely high. So the cost of capital for him is also very high. And then all these microfinance institutions came about, and they are willing to lend to this same guy at a lower cost. Maybe lower in the sense it's still 40, 50, 60% interest. And so that was possible there. Now, in your business, let us say the product is not developed yet, then the risk of the product working itself has a certain amount of risk. And that is in addition to any other risk that other businesses, such as services businesses, have. So there is an additional risk of product. So they may say, oh, this is pretty risky. But having said that, there are a lot of investors who specialize in funding those kind of companies. They're willing to take the risk because they invest in many businesses. And so long as some of them succeed and it addresses a fantastic market need, then they're willing to invest in those kind of companies. So first, you need to understand what risk there is for the capital that you're raising. Obviously, if you feel you're doing a services business, there is no risk, there are customers ready for it, and at least to take it to a certain point, there is absolutely no risk or very little risk, then you would do it on your own. Or initially, nobody wants to fund you because you really cannot convince anybody to invest at that point. Then you bootstrap the company and say, let me build it to a certain extent, establish certain proof points, then I'll go to somebody to fund my business. So first point is, you save up something or put your own money and then develop it to a certain extent. And the next, people who fund early stage businesses or startups, as we typically call them, are friends and family. F and F, as we call it, right? Friends who are willing to trust you, they know you, you're hardworking, you won't put money to waste, and so on. So they are willing to fund you. So, friends and family, of course, they trust you. And, instead of you goofing around, they'll say, okay, let this guy do something. So they're willing to put a certain amount of money. So friends and family. And there's a third category of F called fools who think that you can make a lot of money for them. And, if they're the ones that you can take money from, you take it from them. But there's a danger in taking money from people that you know extremely well, because you have to live with them for the rest of your life. And if you squandered their money, maybe not deliberately, but business doesn't do well, then you have to live with it. You have to live with the same folks. So there is a certain amount of risk associated with that. But the ask from them will be fairly little. It's not like they want to eat up your business, or they will say, come and report to me every day, and so on. So to some extent, the conditions that they put on you are bearable for you. And you feel the risk is worth, I can take that risk and I can borrow the money. So those are the first two avenues that you go to. And the next thing you were to go to, if you still feel there is not too much risk, is to banks. Banks may ask for some collateral, but at the same time, they're willing to take small exposure, and they will say that, okay, I need some collateral, or somebody has to be a guarantor for you. So somebody may sign for it, and you borrow the money. And I'm sure many of you have taken that approach. And again, here the business does not do well, you'll not be able to repay the loan, so that becomes a problem. But banks have their own way of recovering, so you need to figure out whether that is okay for you. So these are still low risk kind of approaches, where you feel the business has the ability to succeed, and those guys do the homework to verify that you are okay to be lent to. Then next comes what are called angels. Angels are those who are willing to take this risk, who want to fund businesses which have the opportunity to become very big. They're not truly institutions per se, but then they have made money by building their own businesses. Possibly they have they want to support entrepreneurship, so they are willing to lend. So these are angels, and they are good for 1 or 2 crores of money at most, a few $100,000, and they understand your business and they feel you have a fantastic idea. They can help you to some extent, so they are willing to lend to you. So they are the folks that you go to. And the next and the last one is really institutional capital, which is venture capitalists or private equity funding and so on, who you go to, and they will not invest at a very early stage where there is a lot of risk, that they don't even know you, or there is no proof points that are being established. But at the same time, they understand the businesses, they understand the market, and they know whether you are can address the market need for that, and they are willing to take a bet and say that, okay, I'm willing to lend you. But the money that's coming from this institution has a lot of strings attached to it. They ask for a lot of things. Of course, they want to be owner in your business, part owner. So if the business becomes very successful, they are taking the equity risk per se. They're not like a bank where they say, okay, pay me the money from selling your land. It may come to that in certain cases if you're collateralized, but typically they take the equity risk. And so they like to hold 20, 30, 40% of your business for the money that they're lending you, and they may do $500,000 or $1 million. Very early stage investors do $1 million to about $3-4 million. That's called a Series A kind of an investment. And for that, they'll hold equity in your company, but it comes with a lot of conditions. Just like bank says, hey, if your business do well, you start returning the money. If you don't have this much money in your bank account, you return the money to me. So those conditions come from banks. And these institutional investors, they'll say, look, before you hire somebody, you need to check with me. Before you open another office, you need to check with me. And before you spend too much money or borrow money from somebody else, you need to check with me. These are all conditions that they'll put, primarily because they don't want you taking this money and misusing it or running away with it, because they do not really know you. They're giving it money to to significant extent to a stranger, but they're trusting that this guy has high integrity, has good ideas, and has a very interesting way of building the business, is why they're willing to take that bet and fund you. So these are how institutions think about it. Now, so depending on how much money you need, like I said, under 500K you may go to angels, or 1 to 3 million you may go to VCs, or larger than that you may go to private equity investors. You approach some of these folks. You can do this research on what kind of companies that they've invested in. Some invest in internet, some invest in financial services, some invest in software services. So you need to do the homework on the folks on what kind of things that they invest in, because each one specializes in certain areas. And also, if there are many people who want to invest in your business, that is good for you, then you figure out who you want to take the money from. What is it that they can bring to your business? Can they help you? Can they bring in other people to help you? And can they help raise money in later rounds? So those are some of the areas that possibly investors can help in. Even angels can do that. Institutional investors can do that. So you need to then figure out who you want to take the money from. And then there are sometimes market sentiments that drive which kind of businesses are able to raise money. For instance, financial services lending today is a hot sector. So there are many. Two of the investors have put money into it. There is a herd mentality even amongst investors. They'll say, "Oh, I have to take exposure to that sector," so they are willing to invest. If you want to say, "I want to sell books," and today that's an old story. It's done deal. So the people may not want to invest. But if you have some other new idea to sell in a different way, especially when the market is going through some kind of an inflection point that will enable you to start a business, those are the kind of businesses that typically folks are interested in. So you need to figure out who it is that you want to go to raise that capital. So the requirements for each of these folks to look at your business is not too different, but at the same time, the emphasis for each of those folks is going to be slightly different, for which you need to prepare a lot of material. So some of you may be at different stages of raising capital, so there are nuances that are particular to you, but on a generic sense, there are 5 or 6 items that you need to have ready with you when you are going for fundraising. Once you've figured out how much money do I need, who should I go to, what are the kind of people who invest in, then these are information that you need to have ready for all these folks. So first thing is what's called an elevator pitch, which you guys may know about, which is what you can tell about your business within about a minute or two, which is the time that it takes to go on an elevator that's going through 10 floors. So you catch hold of some investor and you need to tell them in maybe a minute what your business is, and it should be interesting to him. He should be intrigued. At the same time, he wants to learn more about it. So in 2 minutes, he should be able to say why your business is interesting. So he says, "Hey, why don't you come and meet me? And I want to learn more about it." So to that extent, you have to tell. So you have to be very careful, because that first meeting is very important. You cannot go on how great you are and how yours is the next best thing since sliced bread. Those kind of things. Everybody says the same thing, and nobody has interest in them. You need to focus on what it is that you're doing, why there is a compelling need for something like this in the market is, and why you are the best person to do it. So that's the first thing, which is the elevator pitch that you need to be ready with. We should practice it, rehearse it, and without stuttering, you should be able to say that. Next thing is what is called a teaser, which you send to folks. You don't get a meeting, but you're able to send an email or send through somebody, and then you say the teaser covers all these basic things, but it's self-explanatory. You do not get a chance to explain it. So you should be able to convey what your business is, within that time. What the material is, I'll get to in just a moment, but you should be able to convey that. That's the second point you need to have ready, which is a teaser that you send to people. Third thing is a business plan that you are able to present or you're able to articulate to folks. When you get a meeting with them, you need to be able to go through, it could be a Word or a PowerPoint. And if you're in-person meeting, typically PowerPoint is better. And you go through the entire aspect of the business, which covers everything from who you are, what you do, how you came up with it, why are you doing it, and why you feel you have an opportunity. If it's a product, why are you very differentiated? How are you unique? Who are the other competitors who are doing it? I know I'm covering a lot of areas here, but you need to address all these things in your business plan, and there is enough said about this in the web. Right? And then figuring out why there is a market that is out there, how you can continue to grow, how even if you eat into the market, there is an opportunity to go build a very large business for yourself, and what is the money that is required, in what steps, and to what point are you going to take with this capital. So there are many aspects, and honestly, I cannot cover all this in in 10 minutes. So that should cover everything, the market, the customers, and financial projections, and so on. But in a summary format, you're not going to go into too much detail in any of that. And the next thing that you need to have ready is how am I doing on time? So
good on time.
Okay. So next thing you need to have is a full-blown business plan which covers everything, meaning a lot of nitty-gritty details go into that on how you arrived at the business plan. Because if they like your business plan, then they'll say, okay, what about details on this? What about details on this? Then you need to have that ready. You cannot go away for next week and say, I'll come back with that. You need to have those things ready upfront and send it. So in each of these meetings that you do, what you have to do is, number one, try to get the next meeting. That's really the purpose of this meeting, is to get the next meeting, number one. Number two, convey to them what your business is and why it is exciting. And number three, that you are a credible guy. You are a high integrity, credible guy. Credibility is one of the most important things we look for, because we don't want somebody who takes the money and goes away. So in each meeting, if you can walk out of it with more credibility, means whatever you said last time, you have achieved it and your credibility continues to improve. That's what we look for in each of these meetings. So every meeting, these are some of the things that you need to keep on achieving. And you try to answer the questions, but at the same time, some of these things have to come out.
Mr. Kumar, just to interrupt you here, one question that we get very often from our clients is, how do you approach a VC in the first place, right? So does a cold email work best, or does a foot in the door through a network connection work best? So that is something that a lot of our clients want to understand as to how to go about approaching a VC in the first place.
Yeah, I can. I mean, there is no one way to do it. Of course, if it's a later stage business, you go through intermediaries or bankers and IBank and so on. But at the early stage of your business, you should try to get a meeting in person first. When you can tell an elevator pitch and then say, this is what my business is. If you can meet them somewhere, that's the most ideal thing.
Right.
Or get introduced through somebody because that addresses the credibility factor to some extent, right, instead of a completely cold email.
Right.
Of course, cold email also works, especially if your idea is good, or if there are other companies like that getting funded, and if you have a good pedigree or history of doing something good, good background, or if you have built a company or good education network and so on, even that works. So any of these things work, but you need to get to various folks. Right. And typically entrepreneurs are good about approaching VCs. They figure out a way to do it. And if you're not figured out how to even get to a VC, then there is a more fundamental problem, right? So, but all these work. And the best way I would say is get introduced through somebody that works. But once you're an established business, you don't have to do that. Typically, bankers and so on are able to network, because you need to now approach a lot of people. But you should approach multiple people. You should never talk to just one or two guys,
right?
Because depending on where they are in their own process, they may like you but still may not invest in you, because everybody has certain number of deals that they can do in a year.
Right.
So you need to figure out where yours might fit in.
Right.
So a little bit of competition amongst investors is also a good thing for you, because all these dilution, valuation will become factors to some extent. If they're hungry to invest in your business, then you can get deals that are reasonably in your favor. So for that reason, although there are some preferred methods, I think all these methods work to meet them. Now, again, there are various things that one would look for at a very early stage of the business. Let's say you're just a startup and you don't have too much. Then the integrity and the salesmanship, the clarity of thought of the idea, and what the product is or what the idea is, these things become most important, because there is not much to show. So when you're going to friends and family or angels, this is what I say, this is who I am, and this is my team, and this is what we bring, and this is our idea, and we need to only get to this point because we believe in it, and for that reason I need a couple of $100,000, right? So that's at a very early stage. And then when you go to Series A, which is you're approaching either angel or a institutional investor like a venture capitalist, then there, of course, team will always stay number one. Your own team and the integrity of the people, and what expertise they bring, what the network is always going to be important. But at that stage, what is the product? How mature is it? Are customers trying it out? Do they like it? Are customers willing to pay for it, or are they paying for it? Then it's even better. So each of these metrics, or there are certain number of downloads that are happening, and people are using the product, and you can show to them that product is actually being used. Not only did people download, now they're using it for an internet kind of business. Right. And this is also true for other businesses, where if there is usage, people want it, and this is where the product market fit comes in. Whether you have a product in a very large market which fits fantastically, that people want it, they're willing to pay for it, they are willing to advocate this to others. All these net promoter scores are based on that. That hey, I'm willing to recommend your product to others. Then it's a great product. So your product or your business has to go through this evolution.
Right.
And at Series A stage, we don't look for revenues. We certainly look for some revenue because it validates things, but it is not an absolute must. At least there should be huge downloads or clicks or usage.
Right.
Usage metrics become more important in that stage. As you go into Series B, then we look for revenue and possibly some EBITDA or maybe some profit loss to say that I can get break even. I'm spending this much, so it looks interesting, but with additional capital, I can grow faster. I've addressed the issue of scalability to some extent, because if I had money, then I can continue to grow. So, some of those factors of traction and clicks and, ability to grow have to be demonstrated in Series B.
Right.
Series C and beyond is really, addressing working capital and, hiring sales teams, those kind of things where there aren't too many uncertainties, although product will always continue to evolve, business models will continue to evolve, and so on. But at that point, there has to be a bit more certainty on what the money is going to go for, what is the cash flow, and if I had this much money, where can I take the business to? So the metrics become a bit different, and there may even be a professional CEO at that time, and so on. So even though the team is important, it's not necessary that the founders have to be doing everything. Right? So each stage is a bit different.
Right. So would you say that market validation is a must at the Series A stage itself? Some kind of validation from the market?
It depends. Of course, market validation is always good, right? Market validation is not your friend or your mother or father saying this is great, because they will say good things, right? So it's really, to me, market validation is somebody is willing to pay for it, somebody is willing to recommend it to others. So that is really the validation. And of course, if somebody is paying huge amount of money, that's fantastic. Then then the question of scalability comes in. But if it is in a large market and the people are willing to use it and recommend it to others, that's good validation.
Right.
And if they're willing to pay for it, and if they're willing to pay a lot for it, and those things will come at later stage. So at the very early stage, the expectation is that people want to use this product. So that validation is required.
Right. And size of the market is a factor as well.
See, again, like I said, we started off with the fruit example. He can only sell it in that area, so the market is only that. Although fruits is eaten by everybody, his ability to get to the reach is very small. Whereas, internet businesses or a technology product that you want to sell all over the globe, sitting out of here, the market can be extremely large. And we know that when the market is large, then you'll need a lot of money to make it into a large business, which is what is attractive for people who want to invest several millions of dollars.
Right.
Somebody wants to put 500 rupees, then he's looking at a smaller market, which may be okay. Or if you're an angel investor, tens of millions may be okay.
Right.
Moment you get a venture capitalist, then even hundreds of millions or billions of dollar market is what something would look for. Like for instance, a private equity investor putting in $50 million, he wants the company to go become billions of dollars. Otherwise, he's not going to make a fantastic return. Right. So at each stage, how big is the market and what your product will address will also determine who you go to ask for the capital.
Sure.
Right? So now, the next thing is how to make the pitch to various folks. Like I said, your objective is to get the next meeting, get the intrigue factor going in there, summarize the business, go into the meeting and come out of it with greater credibility and the next meeting, right? So again, these are basic things that people look for. And again, from the perspective of the investor, he is going to do his homework on, is this a good investment for me? Can I put $5 million worth? Is it playing in a large market? Because as a business owner, you may be content with growing it to a certain extent, but unless your ideas match with that of the investor, then he may not have interest in you, or he may not see that the product has the potential that he thinks it needs to reach for him to make the return. Right. So some of those things have to be met. And again, what are the competing products that are out there? Because when you start off, you may be more focused on your product, but by the time you mature, there'll be many players. If it's an interesting market, there'll be many players in them. So you need to figure out who are the competition, what is yours is distinctly different. These are work that people will do. And of course, there is always a question of why I can make projection to go from a million to a billion any day. Projections are easy. The question is, how credible is it? You have to make a projection. Every business has to make a projection based on my idea, what I think I can realistically grow in 18 months, 2 years, with this kind of money, these kind of people, where I can take it to. The point is, every investor will do sensitivity on that. In the sense, he will want to know, is the numbers credible? A lot of people come and say, in 1 year I'll go from 1 million to 10 million to 100 million.
Right.
If there aren't too many other businesses that have done it, then the question is, how can you do it?
Right.
That means you have totally underestimated what it takes to hire people, the talent, the product development cycle, sales cycle, and a lot of issues come in when you're building the business. So you're being immature about it. So you have to be realistic on what one can do. So the only way you're going to convince anybody is to show traction.
Right.
That is, what is the short-term and long-term traction I can show? Especially during fundraising, you need to say, look, the process itself is 3 to 6 months. Like, it'll take you 3 months to convince him that he should invest in your business, unless it's the hottest thing on the planet. So in that 3 months, he's also evaluating to see, is this guy credible? Does he deliver what he promises? So when you go tell him, oh, I can, easily get 2 million next month, or if I say, oh, I'll have, 500,000 customers, next meeting, the first question he's going to ask you is, okay, where is the 500,000 customers? And if you say, oh, this hiccup came about, then you lose credibility. So make sure you, whatever you promise, you're able to deliver in the time frame that you say you will. That's what improves your credibility. So that near-term traction, which is really in most of the business, month-on-month traction or even week-on-week traction, especially during the time that he's monitoring you, is extremely important. So if you're engaging with them, then you need to continue to show that you will continue to deliver what you promised, and even post-investment, you will continue to stay on that growth path. So that has to be reasonably evident. Now, this whole process goes a lot of back and forth. You will ask questions. In the earlier point, I forgot to say that after you have the detailed business plan, you also have to have a very detailed financial projections plan. That is extremely important, because as soon as you get to the numbers at this stage, he is going to throw at you all kinds of numbers and sensitivities and so on, and you need to have that ready. And based on that, your projection should come about. All the numbers that you promise should come from the financial projection. And you cannot do financial projection later. It has to be done at the earlier point when I said you have to have all these materials ready. So when you have that, then you can immediately say, this is why I'm making these assumptions. For that reason, I can get to this stage. And the whole business has to be divided into stages. And you should say, this much money, I'll take it here, and you have to deliver that. So, and then the actual deal on how much equity he'll own, what are the conditions that he'll put on you, is a matter of negotiation. Negotiation has to be pleasant. Right. Nobody expects you to just take everything laying over. To some extent, you need to say why you're asking what you're asking. So it should be a pleasant experience, because it is almost like a marriage that you're going to be working with this guy for 5 years, 10 years, and if at the start itself, you don't see eye to eye, and the inter-exchange between the folks is not pleasant, they'll say, I don't want to work with this guy for so many years, so they may walk away. But everything you do has to be in a pleasant way. Everything can be asked. You don't want to agree to everything the gentleman says, but at the same time, you should know what to ask for, what to negotiate, what are the commercial points, what are legal points, what is it that people typically do not give in on. Right? You have to understand those things, and it is well worth your time to invest in a good lawyer, right, to advise you on how should the agreement be, what are the points to give in, what not to give in. So it's extremely important. I cannot emphasize the importance of it. People have done it before. Each stage is a bit different. The things that you ask for are different. So you need to figure out how this thing happens, and that will result into what is called a term sheet. Right. So all the stuff that you do over from the start to now should result into some kind of a term sheet. Sometimes it can be multiple term sheets that a lot of investors want to put money in. Then you need to figure out who you want to go with, and even that should be a pleasant experience. You cannot burn bridges. One person may say that I'll invest, but it may or may not materialize. Right. And then you may have to go to the second guy. So, be clear, or you may accommodate multiple investors if it works for you. And or you may go to the same investor in the next round. So all these things matter. So you cannot burn your bridges. Right. But from the time that you get to a term sheet to actually them putting money into a company, again, is a very long process. Right. So that process itself takes typically about minimum of 2 months, let's say about 3 months. Because in that process, everything that you said till that day will be verified. So investors go through what is called a diligence, and the diligence has typically multiple components. One is the financial diligence. All the numbers that you said are true, your financials are correct, and you've been having all these board meetings, and all these numbers are captured, and you're selling these many devices. This is the price. You can't say I sold it at this, and then I discounted backwards. So all those things will leave a negative taste. Anything that you have to explain too much will leave a negative taste. And a lot of deals break during diligence, because what they said, they would have said with certain assumptions, which may not be what the investor understands, right? So you need to be very transparent, and numbers should be reasonably clear. Oh, look, this is my revenue, but I'm not, this is not actually revenue. This is, some my order book. Then it leaves a bad taste. What you call revenue by revenue measure should be revenue, and what you call profit should be profit. You shouldn't have to explain that. Oh, if I didn't pay this guy's salary, then the profit would have been that. Those things are all, really very bad tasting. So that during the diligence phase, one is the commercial diligence that one does, and the next is the legal diligence. Is the company incorporated right? Everybody's shareholding is right? All the paperwork is correct? All those legal things that are done. And the customer diligence is also done many a times. If you already have customers, to say, let me speak to the customer. What does he say? Does he like your product? How have you listened to him and evolved the product? So so those kind of things also happen. So there are many of these diligences. Of course, earlier the stage, the intensity of the diligence will be less. As you get to later stages, go through everything, right? Even hire external agencies to do that.
Right. So in a typical transaction, would the diligence costs be borne by the company or the investor?
See, these things are all negotiable,
right?
And typically, in very late transactions, sometimes the investors themselves pay. Right. But in the earlier stages, it's typical that it is paid out of the money that is invested into the company. Sure. That means everybody is really paying for it. Yeah. But if it is, so another typical thing that happens is, let us say for whatever reason, there is a payment that needs to be done, and investor is not investing into a business. That's when the contentious issues come. Who should pay for it? Typically, it is that if an investor doesn't invest because he has moved on for whatever his reason, then they will pay for the diligence.
Right.
But let us say you hid something. There are lawsuits and you didn't disclose, or your financial projections are really not there what they are. Investor have invested a lot of time into you, and diligence cost is one small fraction of it. Then they will expect the company to pay because you have completely misled, you have wasted my time. So the company ends up paying for the diligence cost. Right. But otherwise, everything goes smoothly, then the company pays. That means proportionately everybody has paid.
Sure.
Right? So, and the next thing is really agreements that have to be drafted. And like I said, importance of lawyer cannot be overemphasized here. And these have to be done right. And the process itself takes several weeks. It goes back and forth. To some negotiations will happen during that stage. And both players, both the industry and the investor, have to have the intent to close it. It has to be reasonable. And mentality of promoters, investors have been doing this for a long time, but mentality of promoters, can significantly vary. If they think their business is fantastic, they may be a bit arrogant, but the business is so good, then the investor is to some extent willing to overlook that arrogance. But otherwise, the interaction has to be pleasant, and so long as people are reasonable, because that reasonableness in this transaction will also tell you how reasonable you are with customers, how good you are in negotiating, how good a salesman you are, and so on. So there is a lot of evaluation that can happen. So that mentality of promoters can be judged. At the same time, the business owner or entrepreneur can also judge the investor and see, is this the guy that I want to work with? Right. What is his or her reputation, in the market? Okay, can take the money, but if it's miserable post that, then that is something that they also need to watch. Right. It's not just about valuation. This guy is giving you money, he takes the least amount of business. That's not the only criteria, because there are a lot of other factors that play into it. So then if the investment happens at that stage, then that's where your partnership begins. And from then on, you two are tied together. Investor invests with the expectation that he'll exit the business maybe 3 years, 4 years, 5 years later. And maybe the promoter wants to grow it, or maybe the promoter also wants to sell it at that point and go on. But you are tied. And so long as both you and the investor are doing everything in the interest of growing the business, which means which benefits the shareholder, there cannot be too many differences. Of course, businesses will go through ups and downs, and differences can come. But typically, the decisions that are taken are in the best interest of growing the business. Right. So I covered a lot of things in a very short time frame, and I hope it addresses some of the high-level questions. Right. So if there are particular questions regarding any of the businesses, that I can take it up now.
Sure. So we can just go on to the questions from the audience. So again, so this is something that you've touched on in this talk, but something that we get asked a lot is what sets an entrepreneur apart, right? So are there traits that you look for as a VC? Are there traits in a person that you see and it strikes you as something special and you'd want to work with that person?
Yeah, I kind of touched on it, on what we look for in folks. See, firstly, in any company, especially earlier the stage, it is people are the most important things, right? So it's really the promoter or the promoter team, right? It's not usually one guy. It's usually a team of people and what they bring. One guy may be a technology expert, one guy may be good at sales, one guy maybe good at interacting with people, and so on, right? So, but there are some skills that you can get from outside, like the legal help you can get from outside, or let's say HR help you can get from outside. So some of those things can be outsourced. We don't look for that skill to be in the people, but fundamental, if it's a technology company, then technology better be in-house at that stage. You can hire a lot of people later on, but so some of those, and I cannot overemphasize the importance of integrity of the person. We'll do some background checks on them, how their interaction is with people and so on. The integrity has to be very good wherever he has worked. And the other factor is credibility that I said. Credibility from what he has done in the past, what people say about them, his past employer or wherever he has worked, his co-investor team, or promoter team, and also our own interaction with them. Does he live up to whatever he says? So some of those things. But certainly, I haven't seen too many entrepreneurs who aren't that. They have to be extremely hungry.
Right.
They have to be completely dedicated to it.
Right.
Huge amount of perseverance is required. They cannot give up on easy things. And there are, we also as investors will be testing people, right? We say things to see whether they completely agree with that. They have their own ideas. Are they willing to discuss that? So we don't like people who will, I tell you, oh, no, this is what you should be doing. If he's passively accepting this, although he gets along great with me, that's not somebody who I like, because, that's not the trait. He should have his own ideas on why he's doing, some conviction about it, right, and some kind of, hunch that this is going to work, and hungry to build that business, right? And, he has to show that perseverance and so on. So there are a lot of factors, and some people may be good at something, some people may be good at communicating, and willing to look past that if he has some of the other factors. So I wouldn't say there are just one or two factors, but clear thinking, ability to articulate that will play an important role. Sure. in any discussion. Sure. Whether it's an interview, you may be a great guy. If you can't sell yourself, then it becomes a problem. So I summarize it as a salesman, but the reality is, if you are able to articulate the things that you bring to this business, that's what attracts you to whoever is lending you money.
Sure. Right. So moving on to the next question. So this is again something that we get a lot.
Okay.
So a lot of our clients want to know how you think about valuation at a very early stage, right? So it is ultimately, is it a matter of negotiation? Like you said, many things are at a very early stage when a business comes into a VC. Does valuation ultimately become a matter of negotiation?
Yeah. So I'm going to specifically address it to VCs, right? Otherwise, too early, then obviously you don't have either credibility or negotiating power on valuation.
Right.
So when you go into valuation, you have to see how much money you need, whether you have gone to the right guy to begin with. If you've gone to the wrong guy, then his own appetite is to put too small a money, too large a money, then they'll still want to own certain amount of your business. So let's say you go to a venture capitalist to invest maybe $1 to, let's say, $3, $4, $5 million, then as a firm, they want to own between 20 and 40% in your business, right? So if your business is great and valuation is high, for the amount of money they'll want to own maybe 20%, maybe some even less, but that's a minimum number that they have in mind. And they're the only ones coming in, there's not much maturity, then they want to own 40%, but never want to own the whole business. Look, there has to be enough skin in the game for you. You have to win. Only then, as an investor, I can win. If you just raise money and then you walk away, there is nothing. I don't want to manage the business. So it's typically in that ballpark that people want to own. And at each stage, even VCs invest in Series A, B, C, and so on. You need to figure out what it is that you have. What are the comps, as we call it, comparables in the other kind of companies that have raised money, and how does cash flow dictate a certain valuation or revenue? Sometimes we use revenue multiple or EBITDA multiple or cash flow based valuation. So those things have to justify these things, because even at a venture capital firm, they have to justify this to somebody else in the partnership, because the entire partnerships have to go with it. Right. So valuation does play a role, and there is a little bit of give and take. You should negotiate. You should never take flat what it is. But your negotiating power depends on what else you have in hand. If your business is great, everybody wants to invest, then you have greater negotiating power. Even there, you cannot throw your weight and raise money at humongous valuation, because it has to go through logical step-ups as you go forward. But there is a certain amount of dilution, certain amount of money, and the needs of both the investor and the investee that determines the valuation.
Sure.
And it's a bit of a negotiation that happens at that time.
Sure. So I think we should have time for a couple of more questions. So this is again for your personal view on what exciting sectors are, emerging sectors that you'd be looking forward to investing in the future.
No, so we're an early stage firm. So we continue to invest in all kinds of early stage ideas, but we are generally tech focused. So that means if companies have good technology in them, they are mature to an extent where I define as Series A, Series B, that's where we invest. And tech can be either product or services, or sometimes products sold as services, as in SaaS or software services and so on. So those are the kind of businesses that we are typically interested in. We should have the appetite to take that kind of money, some validation to show that that money can be raised and taken to a next level. But having said that, it doesn't have to be pure tech. Many times we invest in tech-enabled businesses, in the sense there's an inflection or new technology that is coming in that enables a newer business model like internet services and so on. And the areas, financial services is one area that is hot. In addition to pure tech companies, financial services is hot. And anything that internet is changing today in the landscape is something that is of interest to us. At the same time, we are also market driven, or whatever the consumers require. For instance, electric vehicles is hot today, and so there are many investors investing in those areas. So anywhere there is a big market need in the current market, consumer driven growth or high technology for global markets are areas that we are typically interested in.
Sure. So I think with that we should be wrapping up. So thank you so much for your time, and thank you for doing this. And thanks everyone for tuning in. We hope you really enjoyed the session. You can log on to www.vakilsearch.com and go to the fundraising page over there. You will also receive a link shortly for all your fundraising needs and queries. We're happy to assist. Thanks again for tuning in.
Thank you very much. Good luck to you all to go build your business.